In today's video, we'll discuss three popular dividend ETFs: Schwab US Dividend Equity ETF with ticker symbol SCHD, JPMorgan Equity Premium Income ETF with ticker symbol JEPI, and JPMorgan Nasdaq Equity Premium Income ETF with ticker symbol JEPQ. These ETFs are designed for retirees or those who are seeking passive income from their stock investments. We'll look at each of these ETFs in four parts. What does the ETF hold? Its dividend yield and how often it pays the dividend, its past total returns, and the cost to hold the ETF. I'll also talk about the advantages and disadvantages of holding each of these dividend ETFs. My name is Kanak and welcome back to my channel. To learn more about investing, subscribe to my channel. And your support is what keeps this channel running. So show your support by liking the video and sharing your thoughts in the comment section below. Let us start by talking about Schwab US Dividend Equity ETF, identified by ticker symbol SCHD. This ETF follows the Dow Jones US Dividend 100 Index, which is a list of 100 large companies listed on the US stock exchange that consistently pay dividends and are financially stable. Now, SCHD is what we call a passive ETF, meaning the fund managers do not handpick the stock. Instead, it just follows the Dow Jones US Dividend 100 Index. Because of this passive approach, the fees for SCHD are very low, only 0.06% of what you invest. So if you put in $10,000, you would only be paying about $6 a year in fees. Looking at the top 10 companies that SCHD invests in, you will see that they are all large cap companies that reliably pay dividends and have strong finances. Now let's talk about the juicy stuff, the dividends. SCHD currently has a dividend yield of around 3.5%. This means if you invest $10,000, you can expect to receive about $350 in dividend each year. So if you want a dividend income of $35,000 a year, then you will have to invest $1 million in SCHD. Comparing SCHD's dividend yield to another popular investment, the S&P 500 index ETF like WU, SCHD's yield is about 2% higher on an average. However, the total yield of around 3.5% is not as impressive as it may sound. Secondly, SCHD pays dividend quarterly. So, if you are counting on dividend income from SCHD to cover your monthly expenses, then you need to be aware that the timing of dividend payment might not match with the timing of your monthly expenses. Now let us talk about performance. When we look at how much money you would have made over time with SCHD compared to something like WU, which tracks the S&P 500, SCHD returns are lower over the past 1, 3, 5 and 10 years. So historically, investing in WU would have made you more money. In short, SCHD has the advantage of offering higher dividends compared to the S&P 500 index, but it has two main drawbacks. The dividends are paid quarterly, which might not suit with your monthly expense needs, and secondly, its long-term total returns are lower than that of S&P 500 index. So while you might get more dividends with SCHD, your overall returns would most likely be lower compared to the S&P 500 index. Now let us talk about JPMorgan Equity Premium Income ETF, known as JEPI. It has been gaining a lot of attention lately, with almost $30 billion in asset under management. What makes JEPI stand out is its approach to generate dividend. On top of holding a portfolio of large cap US companies, it deploys a strategy of selling out of money covered call options to produce monthly dividend income for investors. But what exactly is a covered call option strategy? Picture this: you own a share of an S&P 500 ETF called WU, which you bought for $100. Now you decide to sell a call option for that WU share at a strike price of $110, earning a premium of $5. Now let me explain call option for those who are new to investing. A call option gives someone the right to buy a stock or an ETF at a set price called strike price before a certain expiry date. When you sell a call option, you are essentially selling the right to buy your stock at a predetermined price called the strike price. So in our example, if the price of WU goes above $110, the buyer of your call option will purchase your share at $110, leaving you with a $5 premium and a $10 of stock gains and profit. But if WU's price drops below $100, the buyer won't exercise their option and you will get to keep both the premium and your share, even though its value decreased. Essentially, with this strategy, you earn income from selling the call option but limit your potential gains if the stock price rises above the strike price. Now in case of JEPI, it invests in the large cap US stocks and uses this covered call option strategy to generate cash flow through collecting the option premium. This strategy has helped JEPI achieve an impressive dividend yield of over 8%. That means for every $10,000 you invest, you can expect to receive about $800 or more in dividends annually. This hefty payout has made JEPI quite popular among investors looking for passive income. Plus, JEPI pays dividend every month, which is great for those who rely on regular income to to cover their monthly expenses. But there are some downsides to consider. JEPI has a relatively high expense ratio of 0.35%, meaning for every $10,000 that you invest, you would be paying $35 in annual fees. While that might not seem like much in the short term, over a couple of decades, these fees can really add up. Now let's talk about performance. Despite its high dividend yields and monthly payout, JEPI hasn't been able to keep up with its performance in comparison to S&P 500 ETFs like WU. Since its launch 3 years ago, JEPI has consistently lagged behind the S&P 500 in terms of total returns over 1 and 3 years. So while JEPI might seem attractive with its high dividend yields and monthly payment, its expensive fees and underperformance compared to the S&P 500 are notable drawbacks to consider. Now let's look at another dividend ETF called JPMorgan Nasdaq Equity Premium Income ETF with ticker symbol JEPQ. Similar to what we discussed with JEPI, JEPQ generates dividend income by selling covered calls, but it focuses on big tech companies listed on Nasdaq 100. JEPQ offers a higher dividend yield of over 9%, meaning for every $10,000 that you invest, you could expect to receive $900 or more in dividend each year. Plus, JEPQ also pays dividend monthly, which is a great news for investors seeking regular income to cover their monthly expenses. However, there are some downsides to consider. JEPQ has high expense ratio of 0.35%, which can eat into your overall returns over the long term. And when it comes to performance, JEPQ hasn't been able to keep up with its benchmark index, the Nasdaq 100. While it is still early days for JEPQ, its short-term performance has been less than stellar compared to its benchmark. So in summary, JEPQ offers the advantage of monthly dividends and a high dividend yield, but it comes with the drawback of high cost and poor performance compared to its benchmark index. Let me know your thoughts about dividend ETFs in the comment section below, and thanks for watching the video.